Assalamualaikum warahmatullahi wabarakatuh. This is Rawan Kamid and I am going to continue the discussion on auditing and internal control. So part 2. In here we go on to explain the structure of an IT audit and the relationship between management assertions, audit objectives, test of controls, and substantive tests. So let us start with the components of financial audit. So, in the attestation function, as discussed by the previous reporter, its product is a formal written report that expresses an opinion about the reliability of the assertions contained in the financial statements. The auditor's report expresses an opinion as to whether the financial statements are in conformity with generally accepted accounting principles or the what we so-called GAAP. This only means that the external users of financial statements are presumed to rely on the auditor's opinion about the reliability of financial statements in making decisions. In what way? So the users must be able to place their trust in the auditor's competence, professionalism, integrity, and independence. Now, there are 10 generally accepted auditing standards or GAAs as presented. Auditors are guided in their professional responsibility by this table presented. So the GAAs. These auditing standards are divided into three classes: General Qualification Standards, Fieldwork Standards, and Reporting Standards. For the first class, from the word itself, general, meaning the auditor's responsibility as a whole, one of which is that the auditor must have adequate technical training and proficiency. Second, the auditor must have independence of mental attitude. Third, the auditor must exercise due professional care in the performance of the audit and the preparation of the report. For the second class, it is named as such as it includes the auditor's responsibility in the field work. First is audit work, which must be adequately planned. The auditor must gain a sufficient understanding of the internal control structure, and then the auditor must obtain sufficient competent evidence. For the third class, it enumerates the standards regarding the audit reporting. First is the auditor must state in the report whether financial statements were prepared in accordance with generally accepted accounting principles. Second, the report must identify those circumstances in which generally accepted accounting principles were not applied. Third, the report must identify any items that do not have adequate informative disclosures. Then fourth, the report shall contain an expression of the auditor's opinion on the financial statements as a whole. GAAS establishes a framework for prescribing auditor performance, but it is not sufficiently detailed to provide meaningful guidance in specific circumstances. So to provide specific guidance, Statements on Auditing Standards was issued by the American Institute of Certified Public Accountants, or the ACPA, as an authoritative interpretation of GAAS. So SAS are often referred to as auditing standards or GAAS, although they are not the 10 generally accepted auditing standards. So for the first SAS, this was issued by the ACPA in 1972. Since then, many SAS have been issued to provide auditors with guidance on a spectrum of topics, including methods of investigating new clients, procedures for collecting information from attorneys regarding contingent liability claims against clients, and techniques for obtaining background information on the client's industry. So, statements on auditing standards are regarded as authoritative pronouncements because every member of the profession must follow their recommendations or be able to show why a SAS does not apply in a given situation. Of course, the burden of justifying departures from the SAS falls upon the individual auditor. So, in conducting an audit, it a systematic and logical process which applies to all forms of information systems. A systematic approach is important in all audit settings, particularly in the IT environment. Since there is lack of physical procedures that can be visually verified and evaluated, this injects a high degree of complexity into the IT audit. As a result, a logical framework for conducting an audit in the IT environment is critical to help the auditor identify all important processes and data files. Now, if we can remember in the previous discussions, particularly those discussions when we are just starting the subject audit theory, the organization's financial statements reflect a set of management assertions about the financial health of the entity, and the task of the auditor is to determine whether those financial statements are fairly presented. So the auditor establishes audit objectives, designs procedures, and gathers evidence that corroborate or refute management's assertions. So these assertions fall into 5 general categories. The existence or occurrence assertion. This affirms that all assets and equities contained in the balance sheet exist, and that all transactions in the income statement on the other side actually occurred. So existence for balance sheet occurred for income statement. This completeness, or the next is completeness assertion. This declares no material assets, equities, or transactions have been omitted from the financial statements. So next, the rights and obligations assertions, which maintains that assets appearing on the balance sheet are owned by the entity and that the liabilities reported are obligations. The valuation or allocation assertion. This states that assets and equities are valued in accordance with GAAP and that the allocated amounts such as depreciation expense are calculated on a systematic and rational basis. Lastly, the presentation and disclosure assertion. This alleges that financial items are correctly classified and that footnote disclosures are adequate to avoid misleading the users of financial statements. Now, generally, auditors develop their audit objectives and design audit procedures based on the preceding assertions. So later, we have the example that outlines these procedures. So back to audit objectives. So these audit objectives may be classified into two general categories. Those relate to transactions and account balances that directly impact financial reporting, and then the second category pertains to the information system itself. This category includes the audit objectives for assessing controls over manual operations and computer technologies used in transaction processing. So here we have an example of establishing audit objective and designing audit procedures based on the management assertions discussed. So, for the assertion, existence, or occurrence, an example of establishing an audit objective under this assertion is that inventories listed on the balance sheet exist. Now, the applicable procedure would be observe the counting of physical inventory. Next, completeness. Example of audit objective in here is accounts payable include all obligations to vendors for the period. And then the audit procedure would be compare receiving reports, supplier invoices, purchase orders, and journal entries for the period and the beginning of the next period. Now, another assertion, rights and obligations. The audit objective example is plant and equipment listed in the balance sheet are owned by the entity and its audit procedure is review purchase agreements, insurance policies, and related documents. And then valuation or allocation. Example of audit objective. Accounts receivable are stated at net realizable value. And then audit procedure, review entities' aging of accounts and evaluate the adequacy of the allowance for uncorrectable accounts. Lastly, presentation and disclosure. So example of audit objective, contingencies not reported in financial accounts are properly disclosed in footnotes. For its audit procedure, it is to obtain information. So we have to obtain information from entity lawyers about the status of litigation and estimates of potential loss. Now, the next thing is that the auditors seek evidential matter that corroborates management assertions discussed earlier. In the IT environment, this process involves gathering evidence relating to the reliability of computer controls as well as the contents of databases that have been processed by computer programs. So, evidence is collected by performing tests of controls which establish whether your internal controls are functioning properly. And then another way of collecting evidence is substantive tests. This determines whether the accounting databases fairly reflect the organization's transactions and account balances. Now, the auditor must determine whether weaknesses in internal controls and misstatements found in transactions and account balances are material. And this will be based on the auditor's judgment. In an IT environment, however, this decision is complicated further by technology and a sophisticated internal control structure. Finally, auditors must communicate the results of their tests to interested users. An independent auditor renders a report to the audit committee of the board of directors or stockholders of a company. The audit report contains, among other things, an audit opinion. This opinion is distributed along with the financial report to interested parties, both internal and external to the organization. IT auditors often communicate their findings to internal and external auditors who can then integrate these findings with the non-IT aspects of the audit. So, here enters audit risk. Accordingly, an auditor only gives a reasonable level of assurance, meaning the level of assurance is less than 100%. In short, the auditor may give wrong opinion. It can happen that the auditor may express opinion that is unqualified, but in fact, financial statements are materially misstated. Example, if the level of assurance is 95%, then there is 5% chance that an auditor may issue wrong opinion regarding financial statements. So this 5% is called the audit risk. Now, these material misstatements may be caused by errors or irregularities or both. Errors are unintentional mistakes, while irregularities are intentional misrepresentation, which is associated with the commission of a fraud such as the misappropriation of physical assets. Now, of course, it is impossible to achieve 100% assurance. So the best way to go for an auditor is to minimize the audit risk to an acceptable level. Now, the acceptable audit risk is estimated based on the value of the components of the audit risk model. These are inherent risk, control risk, and detection risk. So let's discuss these components one by one. Inherent risk. From the word itself, inherent, so it is natural. The risk exists due to the very nature of the cause of the risk. Like industries that have a heavy volume of cash transactions have a higher level of inherent risk than those that do not. Another, there are accounts or accounting treatments that by their very nature is prone to material misstatement, such as revenue. So, some entities have unique revenue recognition practice. So, for instance, from our previous topics in AFAR last semester, the construction revenues. In construction revenues, if we remember, we use judgment, particularly the usage of percentage of completion. Furthermore, placing a value on inventory when the inventory value is difficult to assess due to its nature is associated with higher inherent risk than in situations where inventory values are more objective. For example, the valuation of diamonds is inherently more risky than assessing the value of automobile tires. So those accounting treatments that require estimates and judgments are very risky. So very risky in terms of pagkakamali. Because logically, estimate is an estimate. So above all, inherent risk depends on the business. In short, inherent risk is the risk of material misstatement that is natural to financial statements due to reasons like complexity of accounting treatments, use of estimation and judgment, and significant volume of transactions prior to consideration of internal controls. Auditors cannot reduce the level of inherent risk. Even in a system protected by excellent controls, financial data and consequently financial statements can be materially misstated. Now we have the control risk. In control risk, this is the likelihood that the control structure designed and implemented by management is flawed because of controls that are either absent or inadequate to prevent or detect errors in the accounts. Because of course, internal controls cannot prevent or detect error 100% since entities also consider constraints when designing and implementing controls. Now to illustrate control risk, consider the table shown. So the following is that the partial customer sales record, which is processed by the sales order system. So in here we have the quantity, which is 10 units, the unit price $20, and then the total is $2,000. Assuming that the quantity and unit price fields in the record are correctly presented, the extended amount or total value of 2,000 on the other hand, or unfortunately, is in error. So as we remember again in our previous subject, BIT 102, an accounting information system or the AIS with adequate controls should prevent or detect such an error. So if, however, controls are lacking and the value of total in each record is not validated before processing, then the risk of undetected errors entering the data files increases. So auditors assess the level of control risk by performing tests of internal controls. In the preceding example, the auditor could create test transactions, including some with incorrect total values, which are processed by the application in a test run. The results of the test will indicate that price extension errors are not detected and are being incorrectly posted to the accounts receivable file. Now, for the detection risk, this is the risk that although the auditor performed audit procedures, the auditor still cannot detect the material misstatement. So, auditors set an acceptable level of detection risk, which is called planned detection risk, that influences the level of substantive tests that they perform. So, for example, more substantive testing would be required when the planned detection risk is 10% than when it is 20%. Why? Because detection risk is the complement of the assurance provided by the substantive tests. Hence, as the acceptable level of detection risk decreases, the assurance provided by the substantive tests should increase. So how? By applying more effective substantive procedures. Kaya, more substantive testing is required sa 10% na detection risk. Now, financial auditors use the audit risk components in a model to determine the scope, nature, and timing of substantive tests. So the audit risk model is audit risk is equal to inherent risk times control risk times detection risk. Assume that acceptable audit risk is assessed at a value of 5%, consistent with the 95% confidence interval associated with statistics. By illustration, we can see here, assume inherent risk is assessed at 40% and control risk is assessed at 60%. Again, these two risks are function of the management. Thus, the auditor only assesses these two risks, and cannot change its levels. Now, what would be the level of planned detection risk needed to achieve the acceptable audit risk of 5%? So, using simple algebraic calculation, we may arrive at 20% using the audit risk model. So let's try reducing the control risk value to 40% and recalculate, so the result will be 31%. So if we notice, to achieve an acceptable level of audit risk in the first example, the auditor must set planned detection risk lower than in the second example. So this is because the internal control structure in the first example is more risky than it is in the second case. So now, how are we going to achieve that planned detection risk of 20%? In the first example, the auditor will need to perform more substantive tests than in the second example where the risk is lower. So what can we learn and take note in this is that for a given level of audit risk, there is an inverse relationship between the acceptable level of detection risk and the assessed level of inherent and control risk. So kung mataas si control risk and inherent risk, ibababa dapat si detection risk. Ibig sabihin lang, since bababa si detection risk, meaning tataas dapat si assurance provided by substantive tests. Thus, ang mangyayari is more substantive testing ang required. In contrast, kung mababa si control risk and si inherent risk, itataas dapat si detection risk. Ibig sabihin, since tataas si detection risk, meaning bababa dapat si assurance provided by substantive tests. Thus, ang mangyayari is less substantive tests. So, both tests, controls, and substantive tests are auditing techniques used for reducing audit risk to an acceptable level. The stronger the internal control structure as determined through test of controls, the lower the control risk and the less substantive testing the auditor must do. This relationship is true because logically, the likelihood of errors in the accounting records is bababa talaga when controls are strong. In other words, when controls are in place and effective, the auditor may limit substantive testing. In contrast, the weaker the internal control structure, the greater the control risk and the more substantive testing the auditor must perform to reduce total audit risk. Now, evidence of weak controls forces the auditor to extend substantive testing to search for misstatements. In summary, the more reliable the internal controls, the lower the control risk probability. That leads to fewer substantive tests being required because substantive tests are labor-intensive and time-consuming. They drive up audit costs and exacerbate the disruptive effects of an audit. Thus, management's best interests are served by having a strong internal control structure. So, that will be all. Thank you for listening.